Hi, beautiful people. How are you? I hope you are doing fine. I am the ACCA tutor, Mr. Jerry, and in our second video, we are going to continue from where we left. Okay, previously we looked at the underpinnings of the computations related to IHT, that is inheritance tax in the United Kingdom. Right? We also looked at the importance of your theoretical understandings of the subject matter. All right, because it's not only about computations. You will be required to use your common sense, to use your reasoning, to use your theoretical grounding in terms of explaining things or explaining this tax area, the inheritance tax. So you need not only to be a number cruncher, you also need to advise clients, especially when it comes to tax planning issues. Now, we are moving a step further into our review of the IHT, and we are going to look at IHT liabilities on lifetime and death transfers. All right, I'm sorry, my face was obscuring that part of the title. So we are going to just, as we'll be diving deeper and deeper, you'll discover that we'll be just doing the same thing. Okay, so we are not introducing you to something which you haven't learned in the previous video, but this time around the information is going to be a little bit complex as we go. All right, but just walk with me so that you won't be lost along the way. Okay, so those who who wonder how we teach online, this is the simple trick. All right, in as much as our videos are open to the public, most of the details, most of the benefits of studying as a regular student of ours are not going to be accessed for free. For example, the notes, the full notes are not going to be covered, okay, on the video, but they are there, which are going to be accessed by the students with a lot of examples. All right, we're not going to talk or to explain all the examples or to do some walkthroughs with you on the video. Some of the examples are going to be in the notes. All right, so if you have got our notes, they're going to be benefiting a lot. Then on top of that, we are also going to give you weekly assignments, right? Which means there is a benefit on continuous assessment. You're not going to just watch the video and call it a day. No, you're going to receive a weekly assignment, which is going to test your understanding deeper, all right? And after doing the assignment, the tutor is going to give you a feedback on how you have performed and the areas which you need to improve, so that by exam day, you will be a well-sharpened sword, so that you smart the examiners left, right, and center. Okay, so for you to be able to blow away the examiners, you just have to be a normal student with us, register with us, so that all these benefits accrue to you. All right, and your study journey, you will discover as we go that it has been simplified. All right, without much ado, let us get straight to the issues. Chargeable lifetime transfers, the CLTs. Yes, we have looked at them already, but we need to re-emphasize them. CLTs are made to trusts or companies, all right? But at this level, just know that they have their gifts which have been made to trusts, okay? So the lifetime, the chargeable lifetime transfers you are going to meet in your examination in the ACCA TX-UK paper are only those transfers made to trusts. IHT charged at 20% on excess above NRB. All right. So during the lifetime, the IHT that is going to be chargeable during the lifetime of the donor is just 20% on the excess above NRB. Okay, but this is only when the trust is the one that is responsible of paying the tax. But if it is the donor who wants to pay for the tax, then you know that the tax rate will be 25%. Is that clear? Good. Then upon death, there is going to be an additional 20% if the death occurs within 7 years. All right. So this is why after the death, we have to calculate additional tax on the CLTs. Is that clear, ladies and gentlemen? Now, is additional tax chargeable on pets? On pets, we are not charging additional tax, but we'll be charging the full 40%. All right. But on the CLTs, because we have already charged a certain tax during the lifetime of the person, we are only going to charge additional 20%. But on the pets, because during the lifetime of the person, there was no tax which was charged, we are going to charge a full 40% tax on those pets. Is that clear? Good. So additional tax is only on CLTs, not on pets. In a multiple choice question, the examiner might say, which of the following statements are true? So you need to understand those things. Pets during the lifetime of the person are not going to be chargeable for tax for IHT purposes. And what are pets? Pets are potentially exempt transfers. And what are those? Those are transfers or gifts which have been made to an individual, like a son, a daughter, or a grandson or granddaughter, or a friend, something like that. Anybody else. Okay? So those are the things which we need to understand. Is that clear, ladies and gentlemen? Okay. Now, chargeable transfers. CLTs. Example 1. CLT and immediate tax. Jabu transfers £450,000 into a discretionary trust in July 2024. The chargeable value is £450,000 less the £3,000, which is the AE, the annual exemption for 2024-2025. Okay, which brings down the amount to £447,000. The presumption here is that this job would have maybe utilized the previous year, maybe through a pet. Okay, they utilized the previous year £3,000. Okay, so this time we're not going to use again or to claim that one because it has been used up. That's the presumption I want you to have for now. IHT at 20% is immediately payable by the trustees. Okay, if they agree. I mean, if JAB agrees that the trustees have to pay for that. Okay, so the examiner is likely to tell you who is going to pay. So if the trustees are the ones who are going to pay the tax, then they will be charged at 20%, right? But if it is JAB who is paying for the tax, then you know that it will be 25%. All right, but this tax is only going to be charged on the excess, right? And the excess we are talking about is that difference between £447,000 and the new rate band of 325,000. Okay, you subject this to 20%. All right, which is the immediate tax that has to be paid during the lifetime of the person. If the person then dies within 7 years, an additional tax is going to be charged, which is 20%. An additional 20% is going to be charged. Is that clear? Good. Example 2, additional tax on death. Now, referring to the example above, if Jabu dies within 7 years, say in June 2028, the CLT of 447,000 after the annual exemption, of course, will be included in the death estate calculation. If the IHT rate at 40% is higher than the lifetime rate, which was 20%, and the NRB has been fully utilized, additional tax at 20%, which is 40% minus 20%, may be payable. Taper relief might apply depending on the exact date of death. Don't worry, we'll do it in a structured way, in a tabular format, so that you understand what we are talking about. So there is going to be an example that is going to amplify this point. Now, after computing the death tax on lifetime gifts, we then have to compute the death tax on the death estate, okay, or the death estate computations. IHT at 40% on estate exceeding the NRB. Okay, so the IHT rate upon death is 40%. All right, bear that in mind. Okay, then include pets and CLTs within 7 years. Apply remaining NRB across pets in their order, okay, from the first one to the last, and then apply taper relief if applicable. All right, so after doing all that, you then have to do some tapering. Now, a typical death estate computation looks like this one, right? If there have been some main residence which was transferred to a descendant, a direct descendant, like a son, a daughter, or grandson, all right, you need to include the value of the estate, all right. We know that that value is going to be reduced by the residence new rate band. There is also a residence new rate band, okay, which looks like this. All right, this is the residence new rate band, which is about which is £175,000. All right, in the text tables, you're going to see that again on the text table. All right, then the estate was also, for this hypothetical example, was also including the car. The deceased left behind the car is also going to be included in his estate. And then antiques, each item less than £6,000, all right, and their total are going to be included. Cash in ISAs, okay, individual savings accounts, they're also going to be part of the death estate. All right, while some of these could be exempt in other tax computation, like the chargeable gains or the capital gains tax, for the purpose of IHT, you will discover that they would be included in the estate of the individual who has died. Investment in quoted shares is also going to be included. Then the dates for that person, if they were owning other people, if they were actually owing other people, all right, we're going to deduct those ones. All right, then amount left to wife, this amount, if there was an amount which was left to the wife of the deceased, that amount is going to be deducted from the estate. Okay, it is going to be Okay. Um, yes, the amount which was left to the wife has to be deducted. All right. Then, so you compute and you get the total there. And then this total is going to be further reduced by the resident's new rate band of 175,000 and the new rate band at death, provided it was not used up by the gross chargeable transfers. All right. So there are some people who die without giving anything, whether to their children or to trusts. All right. So it means their um, new rate bands will be indexed upon their death. Okay. And this will further reduce the tax, the tax payable for IHT purposes. All right. So when you do the death estate computation, you need to look back 7 years to check if there were no gifts which could have utilized this new rate band. Then, after you do that, you come to the taxable estate, which is 417. All right. And you then have um, to do your IHT computations, right? So the rate to be applied there is 40%, and your final IHT would be £166,800. Okay, so this was um, a snapshot of what the death estate computation looks like. Okay, but we will do a comprehensive example so that we understand what we'll be talking about. Now, there is example one there. All right, death estate with PET, or potentially exempt transfer. Kira died in March 2025 with a net estate of £600,000. She had made a pet of £100,000 to her brother in January 2023. This pet becomes chargeable on her death. All right. How many years apart? I mean, from the date of the gift to the date of death. January 2023 to January 2024, that's 1 year. To January 2025, that's another year, that's 2 years. And they died in March, so it's above 2 years, but less than 3 years. So here, the pet is not going to be to enjoy the tapering. Okay, so which means there is going to be a full charge. Okay, so the total chargeable amount, all right, is 700,000. The 325,000 NRB is applied, of course. IHT is payable at 40% on the excess. All right, so we are saying the gift, this 100,000, is going to be 100% taxed. All right. Why? Because when at the time of death, the deceased had not lived for at least 3 years. They died within the first 3 years. All right. So their gift is going to be 100% taxable. All right. The pet becomes chargeable 100% of it. Why? Because in terms of the rules of tapering, the deceased should have lived at least 3 years. So this time around, they lived for less than 3 years after making the gift. All right. So the PET which they gave out, is going to constitute part of the estate and be wholly chargeable at 40%. Is that clear, ladies and gentlemen? Good. However, the NRB is going to be applied, right? The new rate band, the whole of it, and then the amount to be taxed will be 375, which is going to be subjected to the 40%, and you get your IHT. Okay, now, example 2. Death estate with CLT and taper relief. Leroy died in November 2025. Okay, don't worry about the future date. Okay, this video is meant to apply until the March 2026 exams. Okay, so we understand that maybe by the time you look at it, the November 2025 date wouldn't have been sustained. Okay, it's okay, don't worry about that. So Leroy died in November 2025 with a net estate of £400,000. In February 2022, he made a CLT. Okay, you now know what a CLT is, all right? That's a chargeable lifetime transfer, right? So he made a CLT of 250,000, and you know that CLTs are only made to trusts so far. All right, that was after annual exemption. All right, so which means maybe they could have made about 256,000 to the trust, but because of the deductions of the 3,000 current year and the 3,000 previous year annual exemption, it has been reduced to 250. He survived for over 3 years, but less than 4 years. So 20% taper relief applies to the additional death tax on the CLT. The NRB is first applied to the CLT. If any NRB remains, it's applied to the death estate. Okay? That's an important theory which you need to have in mind. Now, transfers of unused NRB or new rate bands. Unused new rate bands from first spouse or civil partner is transferable. Okay, so far we have been talking about, or we have been focused on individuals without partners, or maybe divorced individuals, something like that. Okay, that was actually a very real world. In a real world, usually individuals could be married. Okay, that's or could be in a civil partnership. So we were too inclined on a world that wasn't a bit real. Yes, in the taxman's eyes, there are those individuals who are single but have got kids, something like that. Okay, it happens, and the taxman includes you in the population. But there's also a special population, let me call it that way, who are married or in civil partnership. They are going to enjoy a lot of benefits insofar as the IHT is concerned. Okay, so unused new rate bands from first spouse or civil partner are transferable. Okay, this is based on the percentage unused. Okay, if it is 100% unused, then the full 325 is going to be enjoyed by the surviving spouse. All right, but their estate, the last spouse to die or the last partner to die, it means that their estate is going to enjoy the combined NRB, which is 325,000 plus 325 thousand, and this gives us a total of £650,000. Is that clear, ladies and gentlemen? Good. Now, let's move on. Let's move on. Okay. Nomsa's husband passed away in 2023, leaving his entire estate to her. So the husband died first in 2023. His unused new red band was 100%. When Nomsa passes away in 2026, her estate will benefit from a total NRB of 325,000, which is her own, plus 325,000 transferred, making up a total of 650,000 NRB. Okay? Now, if you're a tax agent or a consultant and you're compiling the tax return for IHT purposes, you need to look into these issues to see if the deceased was married and the estate of their partner who died a long way back had been well computed and the NRB had not been used or used. You need to identify those issues to determine them and report your taxes accurately. Example 2, transferring partial NRB. Owen's civil partner passed away in 2024 using 60% of their NRB. The unused percentage, 40%, can be transferred to Owen's estate. If Owen dies in 2027, this estate will have a total NRB of 325,000, okay, plus the 40% transferred from the initial partner estate, okay, the initial partner's NRB, of course, and this gives a total of 455,000 pounds. Now, is it possible that a partner can leave an NRB? Yes, it's very possible because remember there are CLTs which or even the pets themselves could have ate some of the partner or the spouse NRB during their lifetime when they made those gifts and so forth. So the pets or the CLTs would have consumed part of the NRB on their behalf, okay, on their individual behalf. Let's talk about the resident's new red band. Of course, I have already introduced these aspects to you both in the first video and at the start of this video. So the resident's new red band RNRB is available only on death. Conditions: deceased must own a qualifying residence. All right, and a qualifying residence is sometimes called the main residence. Okay, main residence, not any other. Main residence where the deceased has been living in must be left to direct descendants. We are talking of sons, daughters, grandsons, granddaughters, something like that. Okay? For the year 2024-2025, the tax year 2024-2025, this is £175,000. And it is transferable between spouses and is tapered for estates above 2 million. So when your estate has got a value above 2 million, it means that there is going to be a reduction of this amount. the new rate band is going to be reduced. Remember what we did during the income tax computations when we talked of personal allowances, where we say that after 100,000 of income, the personal allowance starts to deteriorate. And when the income reaches £125,000, the personal allowance completely disappears. Is that clear? That type of that idea also applies here. All right, the same idea also applies here because obviously the taxman wouldn't want superfluous estates to be claimed or to be to go uncharged, something like that. So the benefit starts to diminish when your estate reaches above 2 million. All right, that's the idea. Okay, let's look at these examples. Patricia's estate is £600,000, including a house valued at £350,000. Right? So the 600,000 is the total estate she left behind. However, in this estate, there was a house worth £350,000. She leaves the house to her children. So in this case, the RNRB applies. Why? Because the house has been left into the hands of direct descendants. Her estate will benefit from the standard NRB, yes, and the full RNRB of 175,000. Why are we saying full? Because the estate itself, the estate is below 2 million. All right, so then there is no lowering of the benefit. The 175,000 has to be applied. All right, the 175,000 has to be applied. Why? Because the estate is below 2 million. So if we add the NRB and RNRB, that is 325,000 and 175,000, we are going to get a total of £500,000. IHT will be payable on just the difference, the 600,000, which was the estate, less the new rate bans in total of 500,000, and we are going to be left only with £100,000 subject to the 40% death tax. Is that clear, ladies and gentlemen? Now, in a multiple choice question, please bear in mind that the 100,000, this 100,000 is not the death estate tax, but it is the amount chargeable. Okay, the tax itself, the IHT payable is going to be 100,000 multiplied by 40%, which is 40,000. So in a multiple choice question, there's going to be A, 100,000, B, 40,000, C, 0. Okay, and so on and so on. So what you need to do is to know the computations, and your answer should be 40,000. Is that clear? All right. Okay. Now, when there is some RNRB tapering, okay, because we say that there could be some tapering if the estate exceeds 2 million. Okay, so there is going to be some tapering. Now, let's look at example 2. Quentin's estate, is 2.1 million pounds. Obviously, the estate has exceeded 2 million. All right. So if it has exceeded 2 million, then the 175,000 is going to diminish. Right? Quentin's estate is 2.1 million, including his house left to his grandchildren. The estate value exceeds 2 million, so the RNRB will be tapered. The taper reduces by £1 for every £2 over 2 million. Okay, don't worry. The excess is £100,000. Okay, what are we saying? The excess is £100,000. The excess is £100,000. Why? Because we are saying the baseline or the threshold should be 2 million, but this time it is 2.1. So 2.1 minus 2 million, or 2 million minus 2.1, we get 100,000 difference. Right? Remember, 2 million is written like this: 2 million, and 2.1 is 2,100,000. So that's the 100,000. We are saying that's the difference. All right. So the excess is £100,000. So the RNRB is reduced by 100,000 over 2. Why? Because we are saying, we have said here, it is reduced by £1 for every 2. £1 for every 2 simply means £1 over 2 multiplied by the difference, which is 100,000. Okay, and if you do your you get your, if you do your arithmetics, you are going to get a £50,000 there. So this is the 50,000 we are talking about, resulting in an RNRB of 175,000 minus 50,000, which comes to 125,000. So sometimes you will be required to compute this RNRB in the examination, and you should be able to come up with the right figure. Otherwise, this is a rich example material. Okay, this is a rich exam hunting ground. Examiners would love to test students on this particular area. So please watch out. Applying RNRB. Sophie leaves £850,000 estate, including 325,000 house to children. NRB, we know it as 325. It's given in the text tables, and we also know that the RNRB is 175,000. Total new rates, that's 325 plus 175, comes to £500,000. Okay, now we know that the total estate value was 850,000, and we are deducting this amount, which is the total new rate band of 500,000. Obviously, we are going to get 350,000, and this is the amount we are seeing there. And it is going to be taxed at 40%, which is the death tax, and the amount of tax, this is now the tax, the IHT, on death estate. Is that clear? Wonderful. Now, Rebecca leaves an estate of £900,000. which includes her main residence valued at £400,000. She leaves the house to her direct descendants. All right, so it complies with the requirement, which means the RNRB is going to apply in this situation and the full amount of it, because the estate is less than 2 million. Okay, so these are going to be added and they come to £500,000. Okay, so the amount taxable is the difference between the estate value of 900,000 and the total the total new rate balance, okay, or the new rated amount. And this comes to 400,000, which is now taxable for IHT purposes at 40%, and the amount of IHT becomes £160,000. Now, a little bit complex example. Eric died on 1 May 2024. His death estate comprised the following: pounds, house 350,000, personal chattels, chattels 95,000 pounds, shares held in an ISA 16,000 pounds, car 22,000, life insurance policy on life 200,000 proceeds, and 180,000 market value. So for the purposes of IHT computations, please take the amount of proceeds, not the market value of the policy, but the actual proceeds which were given or paid by the insurers. Eric's funeral expenses amounted to £2.5, and remember, the expenses should be reasonable. And yes, of course, the examiner is not in doubt here. They are reasonable expenses and have to be deducted. Eric left his house to his wife and all remaining assets to his daughter. So if the house has been left to the spouse, then the full amount of the gift or the house has to be deducted, or let me just say is exempt. All right, Eric had made a lifetime gift of 100,000 cash to his daughter in September 2022. On the occasion of her wedding. All right, so they made 100,000 cash donation to their daughter in September 2022. All right, that's a pet, isn't it? But this pet, because it has been made for, to a daughter for her wedding, there is going to be what is called an ME, a marriage exemption. Okay, a marriage exemption. Yes, we'll talk about exemptions, but I think this one is £5,000. So the £5,000 of that gift is going to be exempt. All right, good. But we know that this should be a pet. Calculate IHT payable as a result of Eric's death. So we can start with the lifetime gift. Okay, lifetime gift analysis, and then we do the death computation. All right, that's wonderful. Okay, so let me just try to demarcate my board. Okay, now what are we talking about? We are talking of lifetime lifetime tax on lifetime gift. Okay, upon death, because if you die within 7 years of making a gift, that pet which was originally not taxable, immediately is now going to be taxed, provided you die within 3 years. If you die, within 7 years. Now, if you die within 3 years, it means the full gift is going to be taxed. However, after incorporating the exemptions applicable. All right? Now, this guy made a gift, according to the question, he made a gift of 100,000. I'm sure you're seeing that. The 100,000, right? Let me tidy up the board. Let me tidy up the board. Okay, there was a lifetime gift of 100,000 cash on the occasion of the daughter's wedding. All right. Now, the transfer of value TOV was 100,000. Okay, but we know that this was for a wedding, a daughter's wedding, a daughter or a son's wedding. Then it means that the exemption is called a marriage exemption of how much? This is 5,000 pounds. Then there is an annual exemption, right? The AE for current year. The current year was 3,000, is 3,000 actually. And for previous year is also 3,000. All right. It was never claimed. All right. Because you only made one gift, a lifetime gift. All right. Now, what is the amount we are going to get here? 100 minus 5, that's 95. And then we less 3,000, we come to 92. Less 3,000, we come to 89,000. This 89,000, the whole of it is going to be taxed. All right. And I'm sure on the screen you are seeing the 89,000 we are talking about. That's the 89,000, which is going to reduce the new rate band of 325,000. Okay. Now, what about tapering? Okay. Well, we're not supposed to, incorporate tapering in this particular problem. All right. Now, the death occurred on 1 May 2024. However, the gift was made in September 2022. All right. So, September 2022 to September 2023, that's 1 year. To September 2024, that's the second day. However, this Eric died before even 2 years were reached. He died in May 2024. That's after 1 year and some months. So, according to the rules of tapering, this was within 3 years. All right. And if you die within 3 years, you're not going to get any benefit of tapering. Okay. You need to live for 3 years for you to get, you need to live at least 3 years for you to start to enjoy the tapering issues or benefits. Okay, now that's the computation I wanted. All right, and we did that one, which is fine. Now let's do the death estate, the complete figures of it. So we start with the house. All right, the house. I'm looking for another pen. The house was £350,000 according to the question. Then personal charges 95,000 or has been listed there, so it's just an issue of copy and pasting. All right, shares held in an ISA £16,000. There was a car £22,000. So these are free marks which you must not afford to lose. Then life insurance, please, I said only consider the proceeds. Then funeral expenses have to reduce the figure because as long as they are reasonable, the examiner is not going to give a one, even the HMRC. Then the exempt the house, right? So this is why I say the house is exempt, but you need to point out, right? Either you should have put a zero house, you just put a zero. Why? Because the house is exempt, or you just list it. I mean, you put the figure and then you just have to enter another entry to remove the figure because it is exempt. All right, a house to a spouse is exempt. A house to a civil partner is exempt for IHT purposes. Is that clear? Good. Gross chargeable estate. Now, after you do all after you insert all the figures, you then have to total up and you arrive at 330,500. Then you subject that amount to the new rate band at depth. So we start with the 325,000 and then we look back 7 years to see if there are no gross chargeable transfers, right? Gross chargeable transfers, and we have discovered that there was an £89,000 due to a pet, okay? And the amount we put there is that amount after adjusting for all other exemptions, like the marriage exemptions, the annual exemptions, and so forth. And we get that one. And this means that the available new rate band is now 236,000, which is 325 less 89,000, and we get 236,000 pounds. This is then going to be deducted from this amount, okay, from the 330,500, and we arrive at the taxable amount of 94,500. So our IHT based on these figures is going to be this much. That's 94,500 multiplied by 40%, and we arrive at 37,800. Any questions? Please, if you have got questions or any question, please insert them in the comment section. I will attend to them. Okay, I'll attend to them so that I meet your needs and you guys become loyal fans to my channel. I mean, to my videos. All right? Good. So if you don't subscribe, I'm not going to benefit by the end of it. So please subscribe to the videos as we watch them. Now, let's proceed. I think we need to do one example, all right, which I call final example. Then I'll do another example on Excel, okay, on a spreadsheet, so that you guys are comfortable with everything. Because by the end of the day, there is going to be a terrible use of spreadsheets in this particular exam. It's a computer-based examination, and you need to show examiners your skills of using spreadsheets, but not those out of this world skills, but just basic skills, so that you solve the problems as they come by. All right, so let's look at this final non-spreadsheet worked example, right? Okay. Okay, before we do the final example, something came to my mind that I need to point out, because at the start of our first video, in our first video, we mentioned that the objective was also to ensure that you guys know when the IHT has to be paid, okay, and by who. All right, and so far I'm sure you understood that there is a time when the donor themselves have to remit the IHT payable during their lifetime, okay, if they agreed to that setup, all right, or maybe the trustees to which they have given the gift, the trustees would have to be responsible in terms of remitting the taxes to the HMRC. So we have got a situation where we have CLTs. Remember, during the lifetime of the person, of the donor, only CLTs are subject to immediate tax, not PETs, but CLTs. So when CLTs have been done, and we now know that CLTs are those transfers to trusts. So if CLTs have been made, the donor or the trustees are responsible, depending on the arrangement. Sometimes the donor says, let me pay for the gift, for the tax related to my gift, or the trustees themselves. So if the donor is the one paying, we know that the applicable rate will be 25%. Okay, but if it is the trustee, then it is 20% tax. Now, the due date. This tax is to be remitted later of 30 April after tax, later of 30 April after tax year, in which the gift is made, or 6 months from the end of the month in which the gift is made. What are we saying? If a CLT is made between 6 April and 30 September in a tax year, then any IHT will be due on the following 30 April. Okay? If a CLT is made between 1 October and 5 April in a tax year, then any IHT will be due 6 months from the end of the month in which the gift is made. Remember, these are due dates. Due dates. Okay? So you might be doing all your tax planning or cash flow considerations as long as you are within the due dates. All right? So if you make a gift after, remember the tax year, the UK tax year starts on 6 April and ends on 5 April next year. Okay, so if a gift has been made, if you have made a gift to a trust on, between 6 April and 30 September, all right, 6 April, the distance between April and September, we are saying May, June, July, August, September, right? And the April itself, we are talking of almost 6 months gap, all right? So if from the beginning of the year, this is the beginning, all right? If you made a gift from 6 April to somewhere, let's say here, that's September, all right? That's from April to September there, all right? Then NIHT will be due on the following 30 April. So you'll be, you are allowed to remit that by the 3rd April next year. The next year. However, if the CLT has been made after, way after the beginning of the year, maybe between October, okay, somewhere towards the year end, October and 5 April in a tax year, then NIHT will be due 6 months from the end of the month in which the gift is made. So you'll be given 6 months. That is when you, you made your transfer, it was towards the end of the year, right? Towards the end of the tax year. Then we are going to be given 6 months. But if you make your gift at the start of the tax year, then you will be given more time, almost nearly another year. Okay, so you should be aware of that. Now, what about when you die? When should the IHT related taxes be remitted, and by who? Usually, this is remitted by the executors. All right, the executors of the deceased estate are going to be responsible. All right, and the due date. This is the earlier of 6 months after month of death, or delivery of the account of the estate assets to the HMRC. So when you submit the deceased estate accounts, all right, that one, that lists, that tabulates what the estate was, okay, upon the death of the deceased, then you are given 6 months to remit. So which means if the estate was involving shares, let us talk of common shares, for example, if you don't have the money to pay to settle the IHT taxes, you need to sell that estate. Otherwise, the HMRC are going to pounce on you, and they are merciless. So you need to ensure that you remit this tax within 6 months after the death of the deceased, or delivery of the account of the estate assets to the HMRC. Wonderful. Okay, so let us now do the last example. Okay, you guys, I received a lot of complaints about the names I'm using in my in these examples. Some are saying, oh man, we can't read those names and so. Remember, guys, ACCA is a global qualification, and you just have to be used to a lot of names. All right, sometimes we put Chinese names there, or South African Zulu names, or maybe Nigerian Oga names, all those things. All right, but in most of the examples, I'll be using Zimbabwean names. Why? Because I'm from Zimbabwe. Zimbabwe is my station. Zimbabwe is my home. Okay, so I'll be using Zimbabwean names. All right, that's a national bias, isn't it? Nationality bias, which is sometimes reasonable, isn't it? Good. So I think this should be complex, right? I have taken this example from the OpenTuition.com. So you can visit the OpenTuition to see their materials as well, so that you will also be informed as you proceed with your studies. All right. I actually give a thanks to them. I give them credit for being, wonderful people in terms of the dissemination of knowledge, actually in knowledge sharing. Okay, they are not stingy. All right, now example, Tawanda Moyo. Tawanda Moyo died on 1 April 2025, leaving £250,000 to his wife. All right, and the remainder of his estate to his son. All right. Tawanda Moyo died on the 1st of April 2025, leaving £250,000 to his wife, and the remainder of his estate to his son. All right. Now, there is this point I want to highlight. Sometimes the will states that I want my wife to be entitled to 250,000 of my amounts in the bank. or of my monies in the bank, 250,000 or 1 million or whatever. Okay, so when we compute the estate, we need to ensure that an equivalent amount is going to be deducted from the estate. All right, the equivalent amount is going to be deducted if it was going to be given, or if the living spouse is entitled to it. So if those amounts are going to be given to spouses or civil partners, then they are going to be deducted. So that's the meaning of this statement. All right. Sometimes the examiner might say the amounts were bequeathed to the living spouse. They were bequeathed by the deceased to their spouse or living partners. All right. So those amounts are not taxable. They are deductible for IHT purposes. All right. Now, at the date of Tawanda's death, he owned the following asset. 1. His principal private main residence, valued at £300,000, with an outstanding repayment mortgage of £80,000. So which means when we compute the value for the estate, we then have to reduce the mortgage amount. All right. You should ensure that when you present your information in the computation of the death estate, the 300,000 has to be lessened by the £80,000. All right. Tawanda also had a holiday home valued at £140,000. Bank and bank society deposits totaling £230. ISAs with a market value of £50,000. 12,000 shares in Moyo Limited valued at £20 pounds per share. So which means the value here is £20 multiplied by the total number of shares. Okay. A life assurance policy with an open market value of £125,000 at 1 April 2025, from which proceeds of £140,000 were received following his death. So the value we are going to pick is the proceeds, £140,000. Tawanda had outstanding credit card bills of £6,000 at the date of death and had verbally promised to pay medical expenses of £1,000 for a friend. Right? So these were Tawanda's deaths. But do we consider verbal arrangements, verbal dates? Sometimes the taxman, because we know that in our pro forma, the typical pro forma I showed you about the death estate computation, I said that the dates were going to be deducted from the estate. But now, if it was a verbal promise, shall we say that we need to consider it? We need to deduct that. Obviously, the taxman is not going to agree. So that 1,000 is not going to be deducted. Funeral expenses amounted to £6,000. All right. And they seem reasonable. Right? Now, lifetime transfers. These ones are the ones, remember, we normally start with in our computation. All right. And it's very essential that you start with them, because when you compute your death estate tax, you discover that when you arrive at the NRB, you need to then look back 7 years to see if there are no chargeable, gross chargeable transfers to be considered. So it's wiser to start with the lifetime transfer. On 20 November 2018, a cash gift of £40,000 to his son on the occasion of his wedding. So there was a pledge to be considered, but there is also an aspect of ME, the marriage allowance, okay? Marriage exemption of how much? Of £5,000 to be considered. On 15 July 2019, he transferred £405,000 into a trust and paid the IHT due thereon. So, because it was Tawanda who paid the tax, so the tax rate applied was 25%. On 8 December 2023, he gave 4,000 shares in Moyo Limited to his son. At the time of the gift, Tawanda owned 16,000 of the 20,000 shares in Moyo Limited. Share valuations agreed with HMRC at this date were 20% shareholding £8 per share, 40% shareholding £12 per share, 60% shareholding £18 per share, 8% shareholding £25 per share. All right. Now, while we are still here, I think we need to highlight something. We are told that on 8 December 2023, he gave 4,000 shares, all right, in Moyo Limited to his son, all right. So at the time of the gift, the shares were 16,000. So originally they were 16,000, all right. But the total shares in this particular company were 20,000. So the original shareholding was, let me do the mathematics. Let me cancel out the zeros, and we are left with a 4 and a 5. All right. If we divide by 4 in both the numerator and the denominator, we are left with 4 over 5. And what is 4 over 5? This is 80%. So the original shareholding was 80%, which means originally the shares were valued at 25 pounds per share. But after the gift on the 8th of December 2023 of 4,000, it means the shares now they moved to 4,000 minus 16, that's 12,000. So after December 2023, they were now 12,000. And this is synonymous with this particular point, which says that he left out 12,000 shares. All right? Now, don't confuse this value, all right, of 20 pounds per share with the value which we need to compute the transfer of value. All right, the transfer of value is based on the diminution principle. All right, if you have forgotten about the diminution principle, please revisit our video, the first video, the diminution principle. Okay, so for diminution, we are going to consider the percentage of the shares after. This was before, and here we are looking at after. Now, after the distribution of 4,000 to the son, the shares which were now left were 12,000, isn't it? Over 20,000. This means that if we cancel out the zeros, we are left with 12 over 20. Then if we divide by 4 in the numerator, we are going to have a 3, okay? And then here, that's a 5. So that's 3 over 5. And what is 3 over 5? This comes to 60%. And the value for 60%, that's 18 pounds per share. So if you simply guess and say, it's 20, you're going to be lost. All right, the £20 there, that one is just for the value of the death estate. When you are computing for the death estate, we are going to use the £20 per share. But if we are computing for the transfer of value, we are going to use the agreed amounts. Remember, the transfer of value this time around here, we are talking of the value transferred during the lifetime. Okay, the value transferred during the donor's lifetime, and we are computing the PET. Okay, this is useful for the PET. This was a PET. Are we together, ladies and gentlemen? Okay, assume the residence new rate band NRB for 2024-2025 is £175,000. In that, Tawanda's estate qualifies fully for it. Okay, so we should make that assumption that Tawanda was actually entitled to it. So regardless of the fact, here the examiner is simply saying that even if the estate might be above 2 million, you need to assume that Tawanda was entitled to this. All right, just assume whatever figures you obtain, just assume Tawanda was entitled. I mean, Tawanda's estate was entitled to the, new rate band for residency. Is that clear, ladies and gentlemen? Okay, I hope so. So, required, compute the amount of IHT payable during Tawanda's lifetime and upon his death. Okay, so here is the model answer for the lifetime tax computation, which is normally our step 1. So we have the chargeable transfers on the first column, then the paid, the gifts. These were the gifts. These were the gifts in their order of gifting. First of all, there was a paid of 40,000 on the son's wedding. Okay, and we say that this was subjected to the marriage exemption. Okay, the ME 5,000. All right, and then the annual exemption for the current year, which was 2018-2019 year, and the previous year 2017-2018. Please, in the exam, indicate this information is very important these years. All right, then for this part, we can see that 40,000 minus 5,000 minus 3,000 minus 3,000, we arrive at 29,000, which is something that is to be charged. Okay, that's the chargeable amount. But we know that pets are not subjected to lifetime tax as long as the donor is still alive. Okay, so at this particular moment, the donor was still alive, so we are not going to charge any any tax. So this is why we are saying that there is no lifetime tax. We have indicated here. All right. Now, the second gift was a transfer to the trust, according to the question. This part, he transferred £405,000 to the trust. So the only exemption available was the current year exemption. Why? Because the previous year had been claimed. The previous year, 2018-2019 tax year, annual exemption had been utilized. So he is only left with the current year. exemption, which is the 3,000. And this reduces the 405 pounds to 402,000 pounds. And this one is chargeable for IHT purposes. Remember, these are chargeable transfers, chargeable lifetime transfers. So they have to be subjected to an immediate tax. At what rate? Depending on the arrangement. The arrangement, if the donor is paying, then we are going to use 25%. Yes, this time it is the donor who is paying. All right, he pays. Donor paid the IHT due thereon, and so the rate of 25% applies. All right, don't worry, we're going to show you how it was applied. Then we look at another gift, which was the recent gift made on December 8 December 2023. All right, and we need to compute that, and I've shown you the working of how to compute. It was a gift of shares of 4,000, and we are going to use the before and after. Let me show you the working. So before, the shares were 16,000. All right, and 16,000. The examiner is not going to show you how you are going to know the percentages. Okay, they simply give you the percentages as listed here. Okay, these were the percentages: 20%, 40%, 60% shareholding. So what you need to do is to identify the shareholding before, which I showed you. Before, it was 16,000 shares. Okay, and the total number of shares in the company were 20,000, and this gave us 80% shareholding. So that's why we then know that the amount to be charged per share was 25 pounds, because according to the question, if you have a shareholding, let me tidy up the board. If you have the shareholding of 80%, then the amount per share is 25 pounds per share. Then after the gifting, the shares were now 12,000. So 12,000 over 20,000. This means the shareholding was now 60%. And from the question, 60% shareholding means 18 pounds per share. Okay? That's how we obtained the 18 there. So if you solve, you are going to get 16 multiplied by 25, that's 400,000, which was the initial value. But after the gifting, it's now 12,000 at 18 pounds. And that's the amount. And the diminution now, the diminution becomes 184,000 pounds. That was the gift. The amount of the gift or the transfer was 184,000. Why is it a diminution? Because it caused the reduction in value of the donor's estate from 400,000 to 184,000. To 216,000. All right. So this was the value after the gift, the value of the estate after the gift. And the gift itself was the diminution, the reduction, which is 184,000 pounds. So in a multiple choice question, students often confuse the diminution. They end up choosing 216,000 pounds as the diminution. No, 216,000 pounds is the value of the estate after the diminution. After the decrease, isn't it? And what was the decrease? The decrease was 184,000, which is the diminution. Now, lifetime transfers chargeable when made. Remember, the lifetime transfers chargeable are those related to transfers to trusts, which are CLTs. So, these were made on 15 July 2019. According to to our table, these are the CLTs we are talking about. They are the CLTs we are referring to. Okay, now if I come back to this particular table, we can see that the CLTs, after adjusting for the annual exemption of 3,000, were reduced from 405,000 to 402,000. So this 402,000 is the amount which has to be subjected to the IHT. However, we need to first deal with the new rate band of 325,000. Okay? Which means, remember, this was the first chargeable gain. Remember, this person is still alive. Okay? And we are computing the lifetime IHT. Okay? So the pets could not affect this. All right? The pet, although it was made within 7 years, this first pet, cannot affect the new rate band. Why? Because the pets, as long as the person is still alive, they are not chargeable for IHT purposes. Okay, so this is why we are having the 325,000, the full 325,000 at new rate. All right, and then the balance now, 325 minus 402,000, we are having a balance of 77,000 pounds. That is the amount that is going to be subjected to the IHT at 25%. Why? Because the donor is paying and the amount of IHT chargeable is 19,250. All right, so this amount is going to be added to the original 402,000 pounds to give us a gross amount of 421,250. Okay, this has to be carried forward. This is a carry forward amount. All right, we will use it when we then compute the death tax. Okay, when this guy dies, we will need that amount. Now, the person has died. According to the question, he died on 1 April 2025. So there is now going to be additional tax on CLTs and taxation on applicable pets. Why am I saying applicable pets? Not all pets are going to be taxed, but only those which were made within 7 years. Sometimes this is why it is advisable that you need to make lifetime gifts whilst you are still energetic, so that maybe you might live for for above 7 years, which means those gifts are not going to be chargeable for tax purposes. Okay, sometimes if you are given the pet and you are reckless, you consume everything about the pet, then the person dies. All right, you require, if the person dies within 7 years, that pet would be potentially exempt, yes, but it also means that it's potentially chargeable. All right, if the person dies within 7 years, tax is going to be claimed upon the pet. Is that clear? Potentially exempt doesn't mean that it is 100% exempt. Okay. Okay. Now, we are going to then attend to the computation of death tax on the lifetime gifts starting from the first gift. The first gift was the gift made on 11 September 2018, and this one was related to the son's wedding. And we computed the gross chargeable transfer. Remember, I indicated that the chargeable amounts, actually they are gross, okay, gross chargeable amounts. All right, and we indicated here that these amounts, some of them were not chargeable. Why? Because pets are not chargeable as long as the person is still alive. All right. So the only chargeable gift here was the pet, and this amount was the one which we considered as we were computing the lifetime transfers chargeable. All right. And we then say that the gross amount to be transferred, the gross chargeable transfer includes the CLT and the tax attached, which was then carried forward. All right. So when we arrived at the CLT, we'll then see this particular figure appearing again, the 421,250. Okay. Now, let's start with the pet. The pet was determined to be 29,000. All right. This time, because the guy has died, it means we are now including that in our computation for IHT. All right. However, no specific tax is going to be applied on this one. Why? Because it is going to be consumed by the new rate band. Remember, when the person dies, we then recompute the computation. All right. We then recompute everything afresh. All right. So this is why the new rate is appearing again here. All right. So the 325 is going to be applied to the first gift. I'm sure I mentioned that. All right. And this leaves us with a new rate band of 296 after consuming the first pet. Is that clear? Good. Now, so the 296 is going to be at new rate band. However, remember, we are now at the CLT. This is the CLT thing we are doing now. All right. Now, the total CLT, I have shown you that it was 421,250, which was the gross transfer relating to the CLT. All right. Let me show you again. This is the amount I'm talking about. All right. So, this being the total, we need the balance. The balance is the 296,000 minus the 421,250, and we get 125,250, which has to be subjected to the death tax of 40%. We're going to charge 40%, but this amount is only going to be reduced by the 20% we initially paid. By the initial tax we paid earlier on during the person's lifetime. Is that clear? So, in another way, or in another sense, if you make a transfer during the lifetime, that is going to reduce the tax cash flow burden when you die. Okay? Because you are given the chance to pay an immediate tax on the CLT, all right, whilst you are alive. The estate, you'll be required to remit an immediate tax whilst you are still alive. All right, such that when you die, those left behind are not going to be too much tax paying. Okay, so 125 multiplied by 40%, this gives us 50,100. This is the amount of IHT you are going to pay. However, because death occurred on, the gift was made on 15 July 2019, and death occurred sometime into the 7 years, that is on 1 April 2025. There is some tapering, okay? There is some tapering to be considered, which is going to reduce the amount of tax burden. So if you live for 5 to 6 years, you are going to get a relief of 60% on the IHT payable. So which means you need to first compute the IHT, and we did that and we obtained 50,100. But that amount is to be reduced by the tapering, which is 60%, because the deceased lived for 5 but less than 6 years. So 60% is entitled to them as a relief. So this is 60%, 60% of 50,100, and this should be 30,060. All right. So that reduces the IHT payable to 20,040. However, during the deceased's lifetime, when they made a gift, they paid an amount of 19,250. This is the amount which we calculated here. That was the immediate IHT. All right, this is why I say there is some tax advantage in this arrangement. So instead of paying 20,040, they are only required to pay an additional tax of only 790 pounds. Remember, by this time, they could be now in cash flow challenges. So this could be something that is very, very assistive. It's something that is of relief in terms of cash flows. Then we do not stop there. There is also the third gift, which was made in December 2023, which was a PET, a PET. It is also chargeable now. Why? Because the person has died. All right. And they died within 7 years, and actually within the first 3 years. And because they died within the first 3 years, there is no taper to be enjoyed. So a full 40%, the full 40% is going to be applied on that pet. And the pet was how much? Okay, the pet was 184, but because of the adjustment of annual exemptions, we were left with 178,000. So the 178,000 is going to be fully chargeable for IHT purposes at 40%, and we are going to charge that amount. So, excuse me, if we are then asked how much was the lifetime IHT payable, okay, how much was actually IHT due or payable at the time of death, the lifetime IHT. The lifetime IHT is now going to be 790 plus 71,200, and we get the total, which is now due. All right, we're not going to include the already paid amount, but only the additional and the one chargeable on the pet. Is that clear? Good. Now let's compute the final tax, the death tax, death estate tax. Chargeable estate at death as at 1st April 2025. We are going to include the main residence, and in the question we told that the residence was 300,000, but we need to deduct the mortgage of 80,000, and we'll be left with 220,000, which is going to constitute the estate. We were also told that this guy Tawanda had a holiday home somewhere in Spain. He had bank and building society deposits amounting to 230,000. Then some ISAs, 50,000 pounds. Then shares of 12,000 at 20 pounds per share. All right. Then life assurance, 140. These are proceeds, ladies and gentlemen. Tell us of proceeds only. 140. Let me check if that was the correct amount extracted on proceeds. Yes. Proceeds were 140. Fantastic. Good. Now, the debts, we are only going to include the debts which are written debts, not the debts, the 1,000, which was a promise to pay for a friend's medical bills. That one is not going to be entertained by the HMRC. Funeral expenses of 6,000 are also going to be deductible. All right, and we get that total of £1,008,000. Then we deduct the exempt amount bequeathed to a spouse. We are told that he left about £250,000 to his spouse. The gross chargeable transfers in 7 years before death of 628,250 means that the new red band has been fully utilized. Okay, this statement is only referring to these 29,000 plus 421,250 plus 178,000. We arrive at that amount. However, the resident's new red band is available as main residence has been left to direct descendant, leaving the following IHT due. So we are told that the amount so far relating to the death estate, which is chargeable, was 758, but we need to factor in the 175,000 residents new red band, okay, which means this one has to be deducted from 758, leaving the amount of £583,000 being subjected to the death tax at what percent? 40%. And this comes to 233,200 as the death estate tax. Is that clear, ladies and gentlemen? Good. I hope I have done justice to you all. Okay, now I think we need to then check out for video number 3, where I'll be doing a past exam question on IHT. All right, but until then, please feel excited. Continue to do so. All right, you need to love your lives, have good and enough family time, enjoy yourselves as you participate in this noble journey, pursuing the ACCA taxation module. Okay, as you are pursuing the ACCA qualification and are ready to attempt the upcoming ACCA taxation UK exam, please continue to feel excited. I mean, very, very excited. I am signing out. Thank you.